Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
Today, we've got 5 major stories for you. We'll start with SoftBank founder Masayoshi Son's crusade to create artificial superintelligence, backed by a nearly $33 billion bet. Then, we'll jump to OpenAI's CEO Sam Altman, who's now questioning the very concept his company is built on. From there, we'll look at a surprising deal where the US government gets a 15% cut from Nvidia's chip sales to China. After that, we'll cover how Ford's CEO is cancelling some EV products to bet big on hybrids. And we'll cap it off with a truly bizarre $1.17 billion bid from Rumble for a massive trove of Nvidia GPUs. Let's start with a single audacious belief that's shaking the tech world. One of its most powerful investors is convinced that within 10 years, AI will exist that is 10,000 times smarter than any human, and he's betting his entire empire on it. What many might not grasp is the sheer division among the world's top AI experts on this very point. A 2022 survey showed only a 50% chance of this kind of superintelligence by 2061, not 2034. Sun is essentially betting against the consensus, pushing a timeline that many believe is radically optimistic, if not impossible. SoftBank founder Masayoshi Son isn't just investing in AI, he's on a personal crusade. He was recently quoted saying, "For what purpose was Masa-son born? I think I was born to realize ASI, or artificial superintelligence." Now, we're all familiar with AI like ChatGPT, but it's crucial to understand that ASI, or artificial superintelligence, is a completely different beast. It's not just about being smarter. It's about a cognitive ability so far beyond our comprehension, it could solve problems we can't even define, from curing diseases to interstellar travel. It's the ultimate endgame of AI, and Sun believes it's his destiny to bring it into existence. And he's putting his money where his mouth is. SoftBank is planning to pour a staggering 4.8 trillion yen, or nearly $33 billion, into ChatGPT maker OpenAI. This is the man who famously turned a $20 million investment in Alibaba into billions, and he's looking to do it again. His strategy is to own the entire AI pipeline. He bought chip designer ARM for $32 billion. Today, it's valued at over $145 billion. He's building an ecosystem from the silicon all the way to the software. What's driving this is his attempt to create a fortress. By controlling the chips through ARM, the data centers, and the software, he aims to build a completely self-contained AI empire. But this is a massive gamble. The big question experts are asking is whether this creates an efficient powerhouse or a brittle, closed system that can't adapt. More nimble, specialized companies could potentially outmaneuver a giant, slow-moving ecosystem. And, you know, there's a geopolitical angle too. His key chip company, ARM, is UK-based but heavily reliant on revenue from China, placing SoftBank right in the middle of the US-China tech war. It's a complex and risky position. But this is far from a sure thing. This is the same visionary who bet big on the humanoid Pepper robot, a project that ultimately flopped. His massive $100 billion vision fund became famous for racking up billions in losses on bad bets like WeWork. There's a deep psychological angle to this as well. The spectacular collapse of WeWork wasn't just a financial loss. It was a deep personal humiliation for Sun. Insiders say that after that failure, he became laser focused on finding a redemption play. So this AI crusade isn't just a business strategy, it's a comeback tour. He's essentially telling the world, I was right about the internet with Alibaba, and I'll be right again about AI. This intense personal drive is what's fueling this all or nothing bet. This is where the situation takes a more complex turn. According to a former executive, Sun was obsessed with AI long before it was a buzzword. But when the AI boom started, he couldn't invest. Why? He had, quote, used all his ammunition on other companies. He was perfectly positioned for the revolution, but his timing was off. This is a pattern for him. Some call it being a visionary. Others call it having chronically bad timing. With the Pepper robot and early self-driving tech, he was years ahead of the curve and paid the price. The tragic irony is that he saw the AI wave coming, but his funds were tied up in the WeWork disaster right when he needed them most. So after years of playing defense and licking his wounds, Son is back on the offensive, staking SoftBank's future on this single vision. He's made history with one legendary bet before. The only question now is, will this be his crowning achievement, or his most spectacular failure. This isn't just another tech investment story. It's a high-stakes drama about redemption, legacy, and a single man's belief that he can single-handedly accelerate a future that even top scientists can't agree on. We were just talking about one man's absolute faith in creating artificial superintelligence. Now, ironically, let's turn to the CEO of the very company at the center of that bet who's suddenly questioning the entire concept. The CEO of a company in talks for a $500 billion valuation just said the very concept his company is built on is not a super useful term. We're talking about OpenAI CEO Sam Altman, and the concept is AGI, or Artificial General Intelligence. For years, AGI has been the holy grail of tech, the North Star driving innovation and investment. But in a stunning reversal, Altman himself is now pumping the brakes, calling the term into question. According to some experts, what's really going on here is a classic case of moving the goalposts. As achieving that sci-fi version of AGI proves to be incredibly difficult, dismissing the term itself can be a clever strategy. It allows companies to manage expectations, especially from investors, and present their progress as significant, even if it's just incremental. The definition of success becomes a moving target. This bombshell drops right as the company released its long-awaited GPT-5 model. The reaction from some in the field? An underwhelming upgrade. One professor of computer science, Wendy Hall, called the model incremental, not revolutionary. And she didn't stop there, delivering an incendiary verdict on the industry, saying it's the Wild West for snake oil salesmen at the moment. Her comment zeroes in on a huge problem in the AI world, the measurement crisis. The fact is, we don't have globally agreed upon metrics to even judge these systems fairly. Old benchmarks are becoming obsolete as AI gets better. This lack of a standard ruler is what creates the Wild West environment. It's so serious that there are now major initiatives, like one called Humanity's Last Exam, trying to create a new set of incredibly difficult tests just to keep up and have a reliable way to measure what's real progress and what's just hype. But the rabbit hole goes deeper. Another expert, Nick Patience of the Futurum Group, connects the dots directly to the money. He says he feels AGI is, quote, a bit of a distraction promoted by those that need to keep raising astonishing amounts of funding. The financial implications here are just staggering. The money isn't just astonishing, it's astronomical, and it's been fueled by this AGI dream. When we place OpenAI's valuation jump from around $14 billion in 2021 to over $150 billion in 2024, alongside this new skepticism, the contradiction becomes clear. That kind of growth is built on a promise of a world-changing future, not just a slightly better chatbot. So when the AGI narrative starts to wobble, the entire financial foundation could too. And the funding is indeed astonishing. OpenAI was last valued by investors at $300 billion and is reportedly preparing a share sale at a valuation of $500 billion. All of that capital is chasing a dream that its biggest champion now suggests is too vague to even define. Even Altman admits his own new model misses the mark of his personal definition of AGI. However, if you zoom out, you'll see another layer at play here: geopolitics. For years, the race to AGI has been a cornerstone of national strategy, especially in the competition between the US and China. So when the CEO of the leading American player basically says the finish line is an illusion, it creates confusion for policymakers trying to regulate this technology. It could even give an opening to rivals to claim they've achieved a milestone that the US has just dismissed. This all begs the question: if the leader of the AGI race is calling the finish line a distraction, what does that mean for the billions of dollars pouring into the industry? And if the hype is starting to crack, what are investors and the public actually buying? Speaking of the geopolitics of AI, the US government just made a move that has rewritten the rules of the tech war with China. In a stunning development, the government is now taking a 15% cut of every advanced AI chip that tech giants Nvidia and AMD sell to China. So the thing is, this isn't a formal tax passed by Congress. Instead, research shows this is a negotiated condition for Nvidia and AMD to get special export licenses. The government is essentially saying, you want access to this massive market we previously banned? Then we get a piece of the action. It's a novel approach, functioning like a geopolitical fee. This move is being called unprecedented by industry watchers, and for good reason. Just months ago, these exact sales were banned over national security concerns. Now, Not only are they back on the table, but the government is becoming a direct partner in the profits. So why the sudden reversal? This actually signals a major shift in strategy. The previous thinking was to contain China by denying them advanced technology. The new strategy appears to be one of controlled engagement. The idea is that by selling them these slightly less powerful American-made chips, it could actually make China more dependent on US technology, potentially slowing down their ability to develop their own homegrown alternatives. It's a high-stakes gamble between two competing national security ideas. The stakes are enormous. China's AI market is exploding, projected to hit $100 billion this year alone. For a company like Nvidia, which recently shattered a $4 trillion market valuation, getting access to that market is critical. They even developed special, less powerful H20 chips just for China to get around previous restrictions. Now, about what a less powerful chip actually means in this case. The H20 chip was specifically designed by Nvidia with about 41% fewer processing cores than its top-tier H100 chip. But here's where it gets interesting. It actually has more memory and faster memory bandwidth. This makes it very efficient for certain AI tasks. Interestingly enough, Chinese firms are already working on ways to network thousands of these weaker chips together, hoping that software and sheer scale can overcome the hardware limitations of a single chip. But this new deal is raising alarms. One trade expert, Deborah Elms, put it bluntly, calling it, quote, unprecedented. I don't know what the word is, but it's bad. But that's not the whole picture. The real turning point is how this connects to a much larger strategic game. The US Commerce Secretary revealed that these chip exports are being used as leverage in negotiations with China for access to rare earth elements, critical minerals that Beijing currently has a monopoly on. This reveals a critical American vulnerability. For example, China controls about 98% of the world's supply of gallium and 60% of germanium. These aren't just obscure elements. They are absolutely essential for making the very semiconductors we're talking about. Not to mention everything from smartphones to advanced defense systems. This is a true chips for minerals gambit. So what's the government's take from all this? Analysts estimate it could be as much as $2 billion straight from Nvidia and AMD's sales to China. And the destination of that money is key. Reports indicate these funds are intended to be directed back into US chip research, technology security, and the enforcement of these very export controls. So, in theory, the deal funds its own security and America's future competitiveness. This entire arrangement reportedly came together after Nvidia's CEO Jensen Huang met with the White House. The deal was struck. It's a win for China, which gets the chips it wants. It's a win for the US government, which gets a massive payout. The power of that CEO lobbying cannot be overstated. Research shows Huang argued directly to the Trump administration that blocking US chip sales would simply create a vacuum that Chinese competitors like Huawei would rush to fill. His argument was that it's better for China to be using American tech than for them to be forced to perfect their own. This shows the incredible evolving power of tech executives to directly influence foreign policy. But it all begs the question, what does this mean for every other American company, from Apple to Tesla, that sees China as a key market? Is this a new tax for doing business with a global rival? The rules of the game have just been rewritten. We were just talking about the high-stakes business of future tech. Well, another future-facing industry, electric vehicles, is hitting a major speed bump. A major automaker just admitted it's changing its plans pretty massively and is considering pulling some of its EV production out of the US. A decision like this is a huge deal. After all, moving production isn't like flipping a switch. To give you some context, building a new automotive assembly plant can cost between $1 and $8 billion and take 3 to 5 years just to get operational. A move like this signals deep, fundamental uncertainty about the future of the American EV market. The cause of this uncertainty is that the entire financial foundation of the EV industry is being upended. The popular $7,500 tax credit for new EVs is set to end after September 30th. On top of that, a key revenue stream for companies like Tesla and Rivian, where they sell regulatory credits to traditional automakers, is being eliminated. This is a win for gas-powered cars and a massive blow to EV-only companies. And about those regulatory credits, they weren't just pocket change. In 2023 alone, Tesla earned an incredible $1.79 billion from selling these credits. Over the years, That adds up to nearly $9 billion. And who was buying them? Legacy automakers like Stellantis, the parent company of Chrysler and Jeep, spent over $2 billion on these credits just to comply with emissions rules. With that market gone, it's a direct hit to Tesla's bottom line and a get-out-of-jail-free card for some traditional car makers. The shockwaves are hitting the very top. Even Tesla's Elon Musk is bracing for impact, telling analysts, does that mean like we could have a few rough quarters? Yeah, we probably could have a few rough quarters. But where Tesla sees trouble, its old school rivals see an opening. General Motors' CFO declared that GM has an inherent advantage over Tesla, citing its flexibility to build both gas and electric vehicles to meet shifting demand. This decision brings both opportunities and risks. We're seeing Tesla's market share in the US slipping from over 60% down to the mid-40s, while at the same time, GM has been quietly gaining ground. Its EV market share has climbed from 6% to 12%, making it the second largest EV seller in the country. This is that inherent advantage in action when EV demand cools. GM can lean on its gas-powered bestsellers. A luxury Tesla simply doesn't have. The financial pain is already being calculated. The EV maker Rivian just slashed its forecast for regulatory credit income for the rest of the year, bringing its outlook down from $300 million to just $160 million. But in a surprising twist, Rivian's CEO suggested this might be a long-term win, arguing it will reduce competition by making it harder for traditional manufacturers to invest in electrification. His logic points to something economists call a market shakeout. The idea is that subsidies can sometimes prop up weaker companies that aren't truly committed or innovative. By removing that financial support, the market forces a consolidation. The most resilient and innovative companies like Rivian hopes to survive and thrive, while less serious competitors are forced to scale back or exit the market entirely. Still, the biggest strategic shift comes from Ford. CEO Jim Farley confirmed the company is cancelling some EV products and moving out launches. He said Ford is now focused on offering a full range of hybrids, calling it a much better move than a $60,000 to $70,000 all-electric crossover. This all begs the question, is the industry's all-electric future being put on pause? And this isn't just a gut feeling from Ford. The numbers are showing a massive consumer shift. Hybrid sales are surging. In fact, Ford's own hybrid sales jumped an astounding 56% in a recent quarter, setting a new record. The company's new plan is to offer a hybrid version of every single gas-powered passenger vehicle it sells in North America by the end of the decade. They're not just treating hybrids as a temporary bridge, they're betting on them as a core part of their future. From one industry pivot to another, this next story involves a truly head-scratching business move. A company just made a bid to buy another for nearly $1.2 billion at a 32% discount to its current market price. Now, get this. In a normal acquisition, the buyer offers a premium they pay more than the stock price to convince shareholders to sell. Offering a deep discount like this is almost unheard of. It's a massive red flag that suggests the company being bought, Northern Data, might be in serious financial trouble. Research indicates that Northern Data has substantial debt, including a massive €575 million loan it took from its largest shareholder, Tether. So this isn't a hostile lowball offer. It's likely a pre-arranged rescue mission disguised as a sale. That's the bizarre opening move in a new high-stakes tech drama. US video platform Rumble is looking to acquire the German AI cloud group Northern Data. The price tag is a massive $1.17 billion. This move is significant because it signals a fundamental pivot in Rumble's entire business model. By acquiring this massive GPU fleet, Rumble is transforming itself from just a video content platform into a core AI infrastructure player. This is a classic vertical integration strategy, just like when Amazon built AWS. They aren't just buying chips for their own services. They are positioning themselves to compete directly with giants like Amazon Web Services and Google Cloud. So, what's the real prize here? It isn't just a company, it's a treasure chest of the most sought-after commodity in technology today, Nvidia's AI chips. A deal would give Rumble control over a massive hoard of about 20,000 480H 100 GPUs, the gold standard for building artificial intelligence. In the global AI arms race, that's like finding a dragon's lair full of gold. Believe it or not, we're also seeing geopolitics at play. When a US company tries to buy one of Europe's largest and most advanced GPU fleets from a German firm, it rings alarm bells. European governments, especially Germany, are pushing hard for what they call digital sovereignty. They are increasingly scrutinizing foreign takeovers of strategic assets like this, which could mean this deal faces a tough regulatory battle. What really brought this to a head, though, was the involvement of a surprise kingmaker, the stablecoin platform Tether. Tether is the majority shareholder in Northern Data, and it has already expressed its support for the transaction. And for Tether, this isn't just a one-off move. The stablecoin issuer is on a strategic mission to diversify into deep tech. They've already invested hundreds of millions in their own Nvidia GPUs and another 200 million in a brain chip company. This deal is part of a much larger billion-dollar push by Tether to expand its influence beyond crypto and into the core of the AI revolution. Now, here's the detail that ties it all together. If the deal goes through, Tether has a multi-year commitment to become a major customer of the new combined Rumble. They aren't just selling off their asset. They are strategically positioning themselves to secure a long-term supply of the very AI chips everyone else is fighting for. Crucially, this entire deal is conditioned on another key move. Northern Data has to sell off its crypto mining division first. This tells you everything you need to know about the current tech economy. The steady, high-demand business of renting out GPUs for AI work is now seen as far more stable and profitable than the volatile world of crypto mining. This isn't just a simple acquisition. It's a complex power play orchestrated by a crypto giant to guarantee its future in AI. While both companies say a final offer is expected at a higher price, the opening salvo has revealed a new front in the war for technological dominance. The question is, who is really buying whom? And what is the ultimate endgame?
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.